Hello, Mike Evans here. Well, I have no doubt that you have seen the news in the last week about the coronavirus and the impact that's having around the world. And no doubt the recent drop in the U.S. and international markets is you're very much aware of that as well. You know, no one knows what the impact of this coronavirus will have on consumer demand or supply chains. And so there's a lot of fear, a lot of concern that people have, and some people are reacting, and fear is driving decisions and behavior, and oftentimes that's very destructive. We're bombarded by the news, and the news exacerbates what's happening in the world and creates fear and panic and really just kind of plays on our emotions. And you may be feeling the pinch. You may have some anxiety yourself about that right now. I have every understanding that you depend on your portfolio. I'm fully aware that that represents your dreams for retirement, for your family, your financial security, you fulfilling on your purpose for your life. I'm very much in touch with that. And frankly, that's what I do is coaching. It's what I get paid for, is to help you to stay the course, to be prudent, not to panic, not to do you self-harm. And I'm here today to make that case for you, for prudence, and to take a stand for you. You know, we've been through this before. We've seen these cycles, these issues before that happen, whether it's wars, elections, fear, outbreak, terrorism, things that happen, or epidemics. You know, I have a chart here, epidemics and stock market performance. In fact, we can get this to you. Perhaps we'll attach it with the video that we send you. But this is going back to 1980 and looking at 12 different epidemics that have taken place. And if you can see this chart, you can actually see the market. I'm going to touch on a few of these. If you can see that, you can see the increase, a little volatility here, but you can see the increase very significant over that time frame. But there are 12 particular epidemics, and I'll just touch on a few of them. The big ones that you'll probably remember. Remember in 2003, the SARS virus. That was a big one. You know, after 12 months after the SARS virus, 12 months later, the S&P was up 20.8% from where it was at the SARS virus. 20%, over 20% increase in the market following that. And then the bird flu, that was in 2006. The market was up a year later. The S&P was up over 18% a year later. The swine flu, that was 2009. The market increased 36% in the following 12 months. Then there was the MERS in 2013. A year later, the S&P was up 18%. Then the Ebola virus, that was the big ugly, in March of 2014. A year later, 10.4% increase in the S&P during that following 12 months. Then there was the Zika virus in as recently as 2016. A year later, the market was up 17.5%. Interesting, isn't it, that the market was up 12 months later over, following those epidemics. I don't know what that means, frankly. And am I trying to make a case that the market will be up a year from now? Absolutely not. We have no idea about the future of this coronavirus or the impact it will have. We don't know. We just don't know. And what I do know is that markets are random and unpredictable. There's no predicting the markets. We can't predict the next 20% move, up or down. But I am confident that the next 100% move will be up. Think about it, right? I also know that all of the knowable and predictable information is already factored into the price of equities today. It's only the unknowable and unpredictable information that changes prices going forward. So it's critically important that we remain globally diversified in the portfolio. You have a portfolio, if you're with us, then you have a well-balanced, engineered portfolio that has been designed, engineered, with your personal risk tolerance and your investment time horizon to capture market returns over that time frame. Don't know about the short term, but a globally diversified portfolio is prudent, keeping that portfolio balanced, which means we're rebalancing as needed. Think about that. When one part of the portfolio goes down relative to the other, we're going to sell that which is high and buy that which is lower in order to get the portfolio back into balance. Not because we're predicting the future, because we think it's hit bottom or something's topped out. Not at all. We're targeting the portfolio to capture the market returns for your given level of risk, your risk preference. in order to capture those market returns over time in order to fulfill on your purpose, your goals, your purpose for the money, and again, your purpose for your life. I want to reassure you that the situation will take care of itself over time. The critical part is for you just to stay disciplined, to stay prudent, and know that we don't have our head in the sand. We're on top of this, and we're doing what we need to do and what needs to be done. And in fact, we're updating a presentation called OMG Global Armageddon that we've used in the past to talk about these types of events throughout history. But we're updating it to include information about viruses and epidemics, kind of a focus and emphasis, at least for a part of that presentation, to really address these issues. And we'll be dealing with that and sharing that soon. Hopefully you'll be able to attend and participate in that and benefit from that information. But know that we're here for you. We're a stand for you. We're going to do what's right. We're not going to panic. We never do. And we're here to coach you and guide you so you can stay firm and have confidence and peace of mind that you will fulfill on your purpose for your money and your life. Reach out to us if you need to. We're here for you. We'll talk to you soon. Take care and God bless you.